Hi everyone. It's the first time anyone's actually said hello back around the country this week. Keeping up with the changes. There's a lot of changes, and the more you listen to the media at the moment, the more changes you expect to happen. There's an election on, apparently, if you've heard, I'm not sure, an election this year, and superannuation, for whatever reason, has become the number one ticket item. They're all talking about it, but they're not talking about anything positive. It's just they said this and they said that. So there's a lot of bickering going on about superannuation and how it should operate, but without any real substance to what's being talked about. So it's a difficult spot that we're in. At the beginning of the week when I was presenting, we had people talking about this $1 million limit, and if you had more than $1 million you'd be taxed on lump sums. Well, by the time I got to Sydney, we weren't talking about that anymore because that had been pulled off the table. So, things are changing quite frequently. What we will be doing is running our next trustee seminars in June. Okay, so 2 weeks into June, we will run our next lot of trustee seminars. 2 reasons. One, it allows us 2 weeks then, or as trustees, allows us 2 weeks to make those final pension payments, get those contributions into the super fund, just act as a reminder. But 2, it's a month after the budget. So it gives us time to dissect what the government are saying in the budget and hopefully have heard something from a policy point of view from the opposition as well. So it's that run into the end of financial year, and we'll be presenting on that in June. So what are we going to talk about today? We're going to touch just briefly on the contribution limits, but a couple of issues in relation to contributions that we need to be aware about. Reality is that we can contribute up to age 75, and so these rules relate whether we've been making contributions or not, if we've got that ability to contribute. So we need to understand what the rules are. Pension issues, there's plenty of pension issues to talk about. We'll go through them one by one. Some good announcements have come out on pensions. We'll go through those, and just some reminders about obligations in relation to pensions. We've had some new law. There's a lot of law that will be finalised within the next few weeks that will come into play from the 1st of July. We'll run through that, a lot to do with buying and selling assets between the members of the fund and yourselves as individuals. So buying and selling to the fund and the requirements that we're going to have to meet from the 1st of July. So we'll run through those as well. And then there's just some regulatory issues that we need to keep up on or keep on top of that really aren't going to affect you to a great deal. They're the areas that we're certainly going to help you out on, but you need to understand what your responsibilities are and be mindful of keeping up to date with everything there. So we'll go through that. Last one there, ATO penalties. Hopefully this is something that we don't have to look at for our own funds, but it's something that we need to understand is in place or is being introduced by the government to give the tax office more power when it comes to self-managed super funds. Okay, so we'll talk through that issue. If you've got any questions throughout the presentation, please ask. I'll then repeat them and hopefully answer them at the same time. So, first thing that we need to know, 30th of June is on a weekend. What does that mean? That means that the 30th of June is the 28th of June. Okay? The Friday before that weekend is the last day that you can act from a transactional point of view for that transaction to count in this financial year. So if you want to make a contribution, it must be in the fund's bank account by that Friday. If you need to pay your final pension payment, it must be out of the fund's bank account on that Friday. Processing an electronic payment that day won't go through in time. Okay? So you just need to be mindful of the transaction, the banking rules and requirements to ensure that all of your transactions occur before the 30th of June. There is tax legislation that talks about if a due date falls on a weekend or a public holiday, you go the day after. That applies for tax payments and some other tax issues, not superannuation. Tax office confirmed this in one of their industry meetings about 3 months ago. So just a reminder, 30 June is effectively the Friday before 30 June when it falls onto a weekend. If you do pay by cheques, okay, we have cheque accounts for our self-managed super funds. If you pay by cheque, you need to have given the cheque by the 30th of June and then bank it very quickly. Don't hold on to it for any more than a couple of days. get it down to the bank so it can show the money coming out. Contributions. This is just a reminder, okay? We've had contribution caps introduced in 2007. We've seen those contribution caps go down since 2007. So now they've hit the bottom mark. We hope they've hit the bottom mark. $25,000 is our contribution limit for taxable contributions. It is the limit for everybody. So anyone that can contribute up until age 75, $25,000 is the limit. It's the limit that you receive a tax concession on. You can put in more if you want to, but you will be taxed at an additional 31.5%. So you end up paying the highest marginal rate if you go over that $25,000 limit. So if you do have employer contributions go in, you've got multiple employees, you need to be mindful of that. If you're self-employed or have the ability to make a self-employed contribution, keep that limit in the back of your mind. Okay, now's the time to start reviewing that because we're halfway through the financial year. You want to make sure that you're going to meet those obligations there. We've then got this new thing that was introduced. It's actually been introduced since the 1st of July 2011, or it relates to contributions for the 11-12 years. So we're now in the ATO processing point of people who have gone over their cap by up to $10,000. If you have exceeded your concessional contribution cap by up to $10,000, then you can apply for a refund of that contribution from the ATO. Now, I think the word refund is a little bit misguiding because what the process is, just to explain the process very quickly for you, is the tax office write to your super fund and request that excess amount be refunded to them. They then measure that against your personal tax, reassess you'll pay marginal tax on that amount. They'll then look around at the rest of the Commonwealth and see where else you might have debt, apply that to those debts, and then if there's some left, you'll get a refund. Okay? That's how the process works. There's an alternative, and that is that you just pay the 31.5%. You just don't go down the refund process. You pay the excess contribution tax. It's also a one-off. Okay, one-off. So if you go over the cap by $9,000 in the 11-12 year and you choose not to apply the refund and then you go over it again the following year, you don't get that choice. Okay, so it's a once-only opportunity. Opportunity, again, is not really the right word, but for those that have exceeded their concessional cap. So that's just one thing. Again, legislatively, we didn't have the law for that in place last time we spoke. So we now have that out there. The government introduced a higher tax for those that earn more than $300,000 and contribute to their superannuation fund. That's all I can say on that because we still actually haven't seen the law. Okay? It's effective from the 1st of July, but what's effective, well, we don't know. We don't know what $300,000 means. We know it's a number, but we actually don't know how to apply this piece of legislation because there is no legislation yet. So again, what does that mean in an election year? It means if there is no legislation by the time the election happens, then there will be no legislation unless the new government reintroduces something. This bottom point is something that the tax office brought up recently and sent out to the industry recently. With our contribution limits, our non-concessional, so our after-tax contributions, for those over 65, we can contribute $150,000. For those under 65, our limit is also $150,000, but we can bring forward 3 years and put in a contribution up to $450,000. If you put in more than those amounts on one single day, the trustees are required to refund the excess amount. Okay? Effectively, you're not allowed to accept it, so once you recognise that you've done it, you have to refund it. What the tax office have come out and said is if you are transferring shares into your superannuation fund, 2 parcels of shares, I've just given an example there of BHP and Rio, then they are both treated as single contributions. So if you complete 2 off-market transfer forms, lodge them on the same day, and it puts you in excess of that contribution limit, you don't have the ability to refund it. Okay, so you just need to be mindful when you're doing off-market transfers, transferring shares in specie, that you get your values right, that you get the market value right of those shares so that you're not going to exceed the contribution limit. But that in itself is a nice little segue into the next piece of information that you need to know. And that is that the government have now introduced legislation to ban the transfer in of shares off market. Okay, so they have changed the legislation. They have adopted a style of having legislation for non-self-managed super and specifically for self-managed superannuation. And this is the first section that we see it for, acquiring assets from a related party. We can still do it. Okay, we can still buy listed securities from the members, from our trust, from our company. We can still do that, but we have to do it in accordance with the regulations. As you can see, we don't have regulations yet. All right. These laws will apply from the 1st of July. So that's not an issue that we don't have regulations, because we don't need the regulations until closer to 1 July. But what it means is that the way we process the buying and selling of shares, so not just buying, but they've added sections to the law when we're talking about selling. So when we want to buy shares back from the super fund, we have to do it in accordance with the regulations. What do we expect the regulations to say? We expect them to say that all transactions to do with listed securities must be done on market. Okay, so you will need to trade the investments on the market for listed securities. They've also taken a different step with other assets, and that's a very broad statement. That's basically everything except listed securities, and that is that you can acquire them and they must be acquired at market value, except gone is the ability for us to determine what market value is. My us there is a reference to us as trustees, and we will be required to get an independent qualified valuation to transfer those assets into the superannuation fund. Okay, so this is just a slight change, because we always had that market value requirement, but if you went out and sourced enough information to determine what market valuation was, from an audit point of view, that was acceptable. Now you'll have to have a third-party document that shows what the valuation is for those assets. So as I said, these regulations apply from the 1st of July. What does that mean? It means right now, if you're in the middle of doing off-market transfers, you can still do those off-market transfers. You can still do it for any transaction up to the 30th of June this year. That legislation was introduced 2 weeks ago, so we should see that pass through Parliament relatively soon. Pensions. I put these numbers up there for a reason, and that is that this is our last year of discount due to the global financial crisis. So the government introduced a discounting rate for minimum pensions over the last 4 to 5 years, to help preserve the balances which were diminishing because of the performances within the market. So this is our last year at these numbers. 3% under 65, 3.75. They will then revert to the new numbers, which are the old numbers, on the 1st of July. Now that's important, because one of the things that we have had come out in the last couple of years is a situation where the ATO have said if you don't pay your minimum, then you don't have a pension. So it's just really reiterating, these are our numbers that we have to think about, because if we don't make this number, if we don't hit this target, we don't have a pension. But I'm going to spend a bit of time on that in a moment. I've just put up there for you, it's not relevant at the moment, just to show you the differences between the old or the existing numbers and what the numbers will be from next year. So when you move up to that next or that new percentage, you'll need to make sure your periodical payment increases. So what's the benefit of paying the minimum? You pay the minimum, you get an exempt current pension income, which means the income you receive is exempt from tax if you're over 60, and the income the fund receives is exempt from tax. So that is the bonus, or that is the benefit under the current law of having the pension and being over 60. It's minimum or no tax on the withdrawal and no tax in the fund. But to get that exempt current pension income, you have to satisfy the requirements. The very first requirement is you have to pay the minimum pension. We have to pay the pension in accordance with the standards. A couple of the other standards there, the rules about reversionary pensioners, Okay, so you have to, if you're going to have a reversionary pension, you can only revert it to someone who's entitled, your spouse, or in very limited circumstances, children. And there are some other rules about the ability to use your pension for security and borrowings. It's not really an issue that ever comes up a great deal, but it's just one of the requirements of the law. But to get that exemption, you must meet the minimum. Tax Office in 2011 came out and told us if you don't do that, you don't have a pension. And you don't have a pension for that entire year. So the ramifications of that are whatever transactions from an income point of view that the fund has had will be taxable from the 1st of July, even if you only just missed paying the minimum. The other ramifications are many of you would have spent a great deal of time with your advisors looking at your pension strategy and having multiple pensions for tax purposes, for estate planning purposes. You might have a tax-free pension. You might have a taxable pension. You might have reasons for that you want to leave some benefits to adult children. Well, when you don't pay the pension, all that ceases because the pension has stopped and it all goes back into the one accumulation pool. So there's big ramifications for not meeting the minimum from that ruling. It's still a draft ruling. We haven't got a finalisation from the ATO. It was released in July 2011. However, we have had some information recently from the ATO. So in a meeting late last year, they said they will consider circumstances, and if you've missed the minimum by an insignificant amount, then we may overlook it as long as you pay it. Of course, at that point in time, they didn't highlight such issues as insignificant. But they have now. 2 weeks ago. 2 weeks ago, they released a fact sheet. The fact sheet's available on our website. Okay, they released a fact sheet about stopping and starting a pension. And they've given us a reference. They have basically said, as trustees, we can self-assess for the exempt current pension income. Pay your minimum, no problems. If you don't pay your minimum and you meet these conditions, you will still be entitled to exempt current pension income. What are the conditions? That you didn't meet the minimum by a small amount, and I will define small for you in a moment, a small amount, and you made an honest mistake, or it was outside of your control. It's a big problem with that. Tax Office have difficulties believing honest mistakes. All right? We've seen that with contributions and excess contributions, which genuinely were lots of mistakes. And generally the ATO still took their tax. Okay, so they would be wanting to see, really what I would see is something outside of your control. Because it's very hard when you are the trustees and the members to have a genuine reason why that pension wasn't paid. But there will be them, they will arise. So, honest mistake, you then pay that pension as soon as practicable, and we have a definition of practicable as well from the ATO. And the shortfall that you then pay gets attributable to the previous year, therefore meeting that pension. So it won't count in the year that you draw it, it'll count back in the previous year. So meet those conditions and you will get your exempt current pension income. So what do we need to know? We need to know what small is. Small is 1/12. So it's pretty simple. 1 month's shortfall, assuming all months are equal. And in that instance, you will satisfy their definition of small. So there's a big problem there if you are an annual pension payer. Because if you're an annual pension payer, you're going to miss by 12/12. Right? So you've got an issue, and that then doesn't fit into this category. Quarterly payments the same. So it's a good time now to review such things like, if you're on a periodical payment, what day does that periodical payment fall on? Okay? Is it late in the month? Because if it's late in the month, if it's on the 28th or the 29th of a month, generally they're not going to be on the 29th because we run into that February issue most years. But if it's late and we've got weekends and the payment doesn't happen until the Monday, that can create issues for the fund. So you need to look at those monthly payments and see how you can work it in to make sure that you're going to meet the minimum. As soon as practicable means 28 days from being made aware of the underpayment. Now, from an SMSF point of view, that date, to me, there's nothing in the documentation that the ATO have released, but that date is the 30th of June. 28 days of being made aware is not when you get your financial statements 6 or 7 months later. Okay, so I would be working on the basis that if you don't pay the minimum by the 30th of June, pay it by the 28th of July. Get that payment made by that date, satisfying those requirements. So that's the self-assessment. All other cases, you will have to go to the ATO and ask for leniency. Anything above that 1/12. Okay, so we don't want that if we can avoid it. And again, this is where, from a systems point of view, the new program that we're working on, that your funds will operate under, will help, because they will give you that guidance. You'll be able to see the pension payments that you make out of the fund. So that will be, I'm not suggesting that it'll be in place for 30 June this year, mind you, for everybody, but let's talk about the following year, that being available, being an option for the fund. So we do need to keep that in mind. The other pension issue, and this is a significant pension issue for everybody, okay? Because a lot of people, the minimum might not be an issue. They might be taking well and truly more than the minimum. That ruling discussed the death of a member, and it said that a pension will stop when the member dies unless you have an automatically reverting pension. So a reversionary pension in place, which is a contract that dictates that on death the pension will get paid to X. Okay? So this is the rules for the pension. Now, as we've discussed a number of times, a lot of people don't have reversionary pensions in place. They have the discretion, the trustee discretion, to pay a pension if they want to, but they haven't set the terms and conditions of the pension to say that it is going to automatically revert on death. I've also long been an advocate of saying, in an SMSF environment where it's a mum and dad fund, that necessity for auto is not always there, because there's an assumption or an expectation to continue to pay the pension. My position on that hasn't really changed, and the position for the industry has. Late last year, and a big part of the reason why this ruling is still in draft format is industry and the government have been debating this issue. And the government have done a turnabout for the better. They have introduced legislation to say that the pension, or the assets supporting the pension, will continue to earn exempt current pension income until the death benefit is paid. So it's now not a fact about date of death, it's that ability to pay the death benefit out. Again, they use soon as practicable. Forget what I just said about 28 days with practicable, okay? That's for the minimum rules. For death benefit, as soon as practicable can be a lot longer, okay? You may have to redeem assets, you may have some illiquid assets, or the fund may have illiquid assets. There can be other things. We might be waiting on probate, all sorts of issues that will delay the sale of those assets, but the benefit is that the fund will be entitled to exempt current pension income on those assets up until that benefit is paid, either in the form of a lump sum or the form of a pension. So it takes away that need to start a pension the day after death. If that doesn't work, we don't have to worry about that, because we're not having this period of taxable income. So that is a good news story, and that legislation was released last week. So again, hopefully we see that finalised in the very short term, and we can just move forward with some certainty that whether we've got a reversionary pension, a binding nomination, or a discretion, that we don't have a tax liability. And that's the main message that comes out of that one there. So yeah, as I said, that was a good announcement to have received late last year. It applies from the 1st of July 2012. So any death benefit after that point in time, any member dying, so in our current financial year, we can apply this legislation. Trustee responsibilities. So last time we presented, which was June last year, we had a lot of draft legislation about a number of announcements in regards to trustees. They've all been legislated, so they're all in effect for the 12-13 year. So our current financial year. So by the time we get to the preparation of this current financial year, there are a few issues that we need to be mindful of and need to get right if we're currently not satisfying the requirements. So we'll run through those. The first one is that the super fund assets and super fund money must be kept separate from our personal assets. Now, this actually isn't new. Okay, this has always been in the law. But now it forms part of what they call the operating standards of the fund, which means that from an audit point of view, if your assets are held in your personal name rather than the super fund name, the auditor can report that to the ATO, and the ATO can take action against the trustees. Previously, no action was taken. So it was just we would like you to hold the assets in the name of the superannuation fund. The ATO again have been helpful, and this fact sheet's also available on our website. Ownership of SMSF assets. They run through the hows and whats for holding assets in your self-managed super fund. It's the first time that I have seen the tax office come out and play their hand on trusteeship. Inside that document they have said, our preferred approach for all self-managed super funds is that they have a special purpose company to act as trustee of the fund. So this is going beyond the Cooper review where they said people still have choice. Of course, people have choice whether they want to go individual trustees or corporate trustee, but the tax officers have said, if you want to sort the separation of asset issues out, have a special purpose company, because that company only acts as trustee, and therefore the assets are always identified as super fund assets. But of course, they recognise that 75% of funds have individual trustees, and over 90% of every fund being established is established with individual trustees. So there's a bigger problem for them as the regulator, and that is getting the title right. So what they've indicated is the best practice, and most of you would be adhering to this where you can, is to have both trustees listed, or all trustees listed, as trustee for the superannuation fund. That's the best naming convention. But separating the assets is merely an indicator inside the asset that it belongs to the super fund. Might just be the initials SF or SMSF or super account. These are the sorts of things that create separation of assets. But the ATO, as I said, they've released this fact sheet, helps us out, and we now need to listen when the auditors pick these issues up, or when we pick them up and then pass the fund over to the auditors, because we're the ones that will help you work through that process of how to sort the issue out. I know there are issues with changing asset titles, banks, registries. They all have issues associated with change of names, but we need to find a way to be able to do that to satisfy this requirement. The investment strategy of the fund. Investment strategies is one of my points, or one of my pet interests when it comes to self-managed superannuation funds. I tend to believe that the tax office is on our side in my views of investment strategies, and that is that they're an awkward document for a self-managed super fund, because you're the trustees, you're the members, and in most instances you're the beneficiaries. So every investment decision that you make is made in the best interest of the superannuation fund, and this concept of documenting it is an awkward one. How do you do it? How do you document it, or do you need to benchmark things? Well, the rules basically state what you have to do. You have to give consideration. So you have to consider the risk and the diversity, liquidity, the ability to discharge the fund's liabilities. That's what an investment strategy is, more so than Australian shares 20%. They're the benchmarks that you can work on for yourself to achieve your objectives, but you don't need to go to that extreme from a stated investment strategy point of view. But you need to have an investment strategy. And they've changed the regulations to say that you now must regularly review your investment strategy. Now, again, most prudent trustees would be regularly reviewing it, whatever regularly means. Again, another word thrown into the law that doesn't have a definition. So we've defined it annually. A minimum of annually, that you will regularly review your investment strategy. And administratively, we've helped. We've added a sentence to the trustee declaration. You all sign a trustee declaration in your financial statements every year. We have added a sentence that says, I have reviewed my investment strategy in accordance with the regulations. That's not taking the responsibility away from you to do it. It's taking the need to additionally document that review. So you're still required to review your investment strategy. But now we've at least documented that part for you. The other thing about investment strategies, is insurance. Non-self-managed super has created a world, or we're entering into a world where insurance is going to be mandatory unless you opt out. They can't impose that in a self-managed fund because you're the trustees. You don't have to offer insurance. But a new law has come in, a new part of the regulations. So for us, we've snuck it into that standard sentence as part of the annual declaration, that you must consider insurance for the members of the fund. The fund must consider insurance. So that's life insurance, total and permanent disablement insurance. You must consider it. Don't have to have it, just have to consider it. So again, it's a change to the investment strategy that the fund, in trying to perform to provide for our retirement, we're going to invest in these ways, and we've considered insurance, full stop. Or we've considered insurance and are going to take out insurance or hold insurance outside of super. But again, the thing with insurance is that they use statistics. I said only 13% of self-managed super funds held insurance. So the SMSF industry was underinsured. They didn't talk about the fact that most people had enough money in their self-managed super fund that they didn't need or require insurance, or they couldn't get insurance, or they were pensioners, and so they had hit an age where the premiums were too high for insurance in the super fund. There was no necessity for it. So the stats didn't really tell the appropriate story, but now we have to consider it. But that can be just one of the things that you ponder as part of the annual return preparation, is considering what you're going to do with it. Valuing the assets. Now this, again, is an addition to the legislation specific to the preparation of the annual returns, that the fund must value the assets at market value. Well, we already do that. That guide that some of you would have picked up from the table outside explains exactly what we do from a valuation point of view. That's more than, or at least equal to, what the tax office wants you to do. So that means there's no real change in our administrative process from a market valuation point of view. What it does mean is for those that have the administration performed maybe by their long-term accountant who has always recorded the assets at cost, because the law allowed them to, they will have to make adjustments. Okay? The law until now allowed you to record the assets at cost, but we never felt that represented your fund appropriately, and that's what they've recognised as part of that legislation. So we have this change in place, but from a trustee point of view, it's nothing that you really need to act any further on, because we're already satisfying that requirement for you. So here's the worst part of today's presentation. But let's hope it's not. Let's hope it's not one of those areas that we actually need to worry about for our own self-managed superannuation fund. Government have introduced a new penalty regime that applies specifically for self-managed superannuation funds. So there is already a penalty regime out there. For every section, for everything that you can do wrong, there is a penalty that can be applied by the regulator. But if they want to apply it, they have to take you to court. And the cost associated with that often doesn't befit the benefit, the loss of your retirement benefits, other things like that. So they are very mindful, as the regulator of self-managed, they're very mindful that we are talking about retirement benefits, and they don't want to diminish those by imposing these penalties of 45% tax, of non-compliance status, of removing you as trustee of the fund. That can be extreme for small breaches of the legislation. But the current system allows you to continually breach the legislation and the ATO do nothing about it. And that's not right either, because you want to shut down these continued repeat offenders who breach the law. So we have a new penalty regime coming in from the 1st of July. Now, all indications from the tax office are that there will be leniency in year one. I would say there'll be leniency in year one if you are not a previous offender. But I suspect that if you have continually done things wrong, then the ATO could come down very early to make example of certain funds. But they've got a couple of things they can do. The first thing they can do is they can give you what they call a rectification direction. So you do something wrong, and I'll give you an example: lending money to the members or relatives of the superannuation fund. So 2% of self-managed funds are reported to the tax office every year, roughly. So that's not a great number out of 480,000 odd. That's not a huge number that are reported. But of that, 1 in 5 have lent money to a member or relative. There is a strict prohibition on that. There's not even a $1 allowance. You cannot lend money to a member or relative. So what this rectification direction can do for that 1 in 5 is it can give the ATO the ability to say, okay, let's fix it by paying it back with this interest rate by this date. The tax office will tell you what to do and when to do it. Previously, they relied on you telling them how you were going to fix it and then whether they would accept it or not. You can still do that, but this is going to be their way to be able to also act and tell you what to do. Now, if you don't follow their direction, then there are penalties that they can impose. So when you get it, follow it. The second thing that they introduced was an education direction. This was heavily supported by the industry because when they did their review in the superannuation of the entire superannuation industry and particularly self-managed, they said that trustees, we need to work out what their level of education is, and we think we should make education mandatory for trustees. The industry jumped up pretty quickly and said, you don't need to do that. Most of the trustees have a reasonable level of education or access to people that can help them out in those situations. So making it mandatory is just going to push people away from maybe taking that, that step as a trustee of a self-managed superannuation fund. The industry supported this concept of mandatory education when you do the wrong thing. And so they've introduced it. They've introduced a penalty regime which says that the tax office can require you as the trustees to undertake some form of education based on what you've done wrong. They will also tell you who can deliver that education, and they will tell you that you don't have to pay for that education. So our dilemma, or dilemma is not really the word, our interest is who will be this education provider. We obviously have a fairly keen interest in education, and so we will start that conversation with the ATO once they know what an education provider is, to see what we can do as far as trustee education. I mean, obviously we run sessions like this, but would we need to run then independent sessions on loans, on borrowing, on other aspects? That's something that we would need to work out with the ATO. But what the education direction does is it says you must undertake this education by this date, and then send us your certificate to say that you've attended it. So you need to have proof of attending, and then after that you have to sign a new trustee declaration. Okay, so all trustees since 1 July 2007 have had to sign a trustee declaration that says they understand their responsibilities as a trustee. You'll have to submit a new trustee declaration if you get an education direction. So this is a good approach from the ATO to help trustees learn what their responsibilities are, to ensure that they don't do the wrong thing. Again, as I said, these penalties will come in on top of the other penalties that apply. So what it means is if you have done something real bad, and thankfully it's not something we see a great deal of. You know, we see errors. There are always errors. Always there are issues that we report to the tax office, that we're in communication with the auditors that get reported to the tax office, and we can normally report them as fixed. Okay, so that's going to continue. There's not going to be any sort of magic wand that stops people from making mistakes. But the worst of the worst still have a penalty regime. And what the ATO can do is they can impose these smaller penalties that we're about to discuss, but then if they want to take it further, they'll refund that money, but take you to court for the much higher penalties. Now, the much higher penalties are closer to $250,000, 5 years jail. When we look at the next slide, you'll see that that is fairly significant compared to what this penalty regime is. Also, we need to understand what the cost of the penalties is, because what the ATO do is they determine, or what the legislation does is says how many penalty units apply. What's a penalty unit? A penalty unit is $170. If you go out there and search up some stuff on these penalty regime, you'll probably see $110 written in a lot of the examples. That number changed in the Christmas New Year period, a bit of a Happy New Year from the Crimes Act, was they increased the penalty regime from 110 to 170. It hadn't been increased in something like 35 years or something, and so it will be reviewed annually. So this is a moving number per penalty unit. So I just want to give you an idea. This is not, you don't need to A, read or understand any of these sections, but I will run through a couple of the key points for you and highlight the issue. You see the most extreme penalty there is $10,200, so that's our 60 penalty units at $170. These penalties are imposed on you, okay, not the fund. So these are not a fund penalty because they don't want your fund to be diminished. They don't care about your bank account outside of the super fund, but inside the super fund they don't want to affect your member balances. So these are personal liabilities. Covering off on a lot of specific areas. Loans to members and relatives. So if you go and lend the kids $5,000, A, you might be told via a rectification direction to get that $5,000 paid back in, but B, it's going to cost you $10,000 to do it. Okay, so it's not worth it. It's not worth the fact that you have this money accessible so you think it's available. But let me tell you, if you're over retirement age and you have access to your money, it's not a loan. It's a benefit payment. It's a pension. If you can take your money out and you want to support children or other family members, you can do it, but just don't try and create something that it isn't. If you want to have a loan with them, have that loan outside of the super environment. Pay your benefit to yourself, then set up a loan. If you really want to go down that path, just don't involve the super fund in that transaction. Same with borrowing. A couple of these things, in-house assets. So assets in related parties. Certain assets in related party investments, we have a limit of 5%. If we go over that 5%, we have to sell the assets. If we don't sell the assets, that's where the $10,000 penalty is going to come in. Lots of little penalties. As I said, education direction. If you don't follow that, it's going to cost you $850. So 5 penalty units. Much lower than obviously the more extreme things. But that top one, operating standards. So when you look at that list, and SIS has clearly over 350 sections if we just look at the bottom line now, which is 347. So SIS is a pretty big act. So that table doesn't look very big as far as which sections can impose penalties. But that top one, the operating standards, is pretty much a catch-all clause. Because the operating standard is everything to do with contributions, everything to do with pensions, everything to do with the investments, everything to do with preserving your benefits, pretty much everything to do with your trustee responsibilities is caught under that operating standard one there. Reviewing your investment strategy, considering insurance, market valuation, all those things that we've just discussed fit neatly into the operating standards. Now, of course, a big part of our job is to make sure that you don't have these issues arise. We can't stop you lending money. We can't stop you borrowing. We can tell you that you can't do it, or the circumstances where you can do it. But we can certainly make sure that you value the assets correctly. We can certainly make sure that 2 people sign the financial statements. If you've got 2 trustees, and that's an important one, we get this a lot. 2 trustees, we get the financial statements back with 1 signature. Whoever doesn't sign, it's going to cost them a penalty. Okay? When you have two trustees, the law requires both of them to sign. When you have more than two, then you only need two signatures. But if you have one or two, then both must, or the singular, must sign the financial statements. So these are the little things which over the years, like, oh yeah, we'll get it before we have to ask for it, just ensure that that's done. That leads to another point, which is powers of attorney. Powers of attorney aren't relevant in superannuation from a signing point of view. If you have a power of attorney because you're travelling around the country, and so you get your financial statement sent home and somebody signs on your behalf, that means nothing. Okay? There are different rules, and I just want to highlight this. An enduring power of attorney is a very different situation where you can replace a trustee, but that's a full replacement process. That's like adding a new member. But just a stock standard power of attorney, because of distance, is not going to satisfy that requirement. So these are the little things that you need to be mindful of. These penalties will come in place from next year. We will send out some more information on this. So one of the key messages from today is that I'm putting together our next trustee newsletter. I'm actually going to put together a trustee newsletter and a trustee bulletin because I want to separate the pension information. I want people to not get the pension information lost in amongst all the other things, but then a lot of this trustee stuff will put in a separate document. So my expectation is that I'll have that written within the next 2 weeks, and then we'll start distributing that, but well in time for your 30 June obligations. Our SMSF levy it's been indicated that will rise next year. What is the levy and what does it do? The levy is our fee, basically, to the tax office to regulate our industry. Okay, so fair enough that it went from $45 up to a higher amount because $45 was really not going to support the ability for the ATO to look after the industry. But it's been seeing some reasonable increases over the past few years as more requirements have been put on the ATO, excess contributions, $10,000 refunds, maybe $300,000 income issues. All these things have to be regulated by the ATO. They have to be resourced. That costs them money. That's what the levy does. It goes straight into the ATO's regulatory spending pocket to be able to regulate and educate this industry. So the expectation is next year that will go up to $259. It's currently sitting at about $190 for this current year. The other thing is I'm not sure how many people, if any, in this room have limited recourse borrowing arrangements. Just my final stat for today is Cavendish administer just shy of, by a couple of hundred, 5,000 funds. So we're in that sort of 4.7, 4.8, depends what number we want to use for marketing purposes. But we're above 4,500 funds. We have 19 funds with limited recourse borrowing arrangements. Okay, so statistically, there's a lot of talk about limited recourse borrowing arrangements for not as much activity, but that will change. You know, it would change if there's clarity around whether it's a financial product and a number of other things. But when you go out of this room and you read the papers or you listen to the radio, you will hear people telling you to buy property in your self-managed superannuation fund. Okay, there are those out there actively promoting it. And those active promotions are creating issues with the tax office because they don't know the self-managed super fund rules. And so people are getting the loans in the wrong name. They're putting the property in the name of the super fund rather than the borrowing trust, the trust that's there to hold the asset on behalf of the fund. There are requirements that we have to meet, and the ATO are highlighting via an alert to say, get it wrong and it's going to cost you significantly because you'll have to unwind the asset. And if we're generally talking about property, that's a big amount of unwinding to be done. So for those that are contemplating it or doing it, we're there to help to look at the documentation to support that you're getting it right. And if you're about to enter into it, we can certainly make sure and review the documents to see that you've got everything correct there. I'd always ask the question, if you're going to lawyers to help out with things, is one, do they know what a limited recourse borrowing arrangement is? And do they understand self-managed super rules? Because if those lawyers are linked to the brokers, the mortgage brokers that are just selling the properties, they might not have that experience that a superannuation lawyer will have. And it's really just a warning. We want people to make sure they're not caught under that trap, because it can be a costly trap. So that final point, I've just highlighted that there. We will be issuing trustee newsletters, okay, keeping you up to date with that information. Ideally, I'd like to get to a place where we can send that information to everybody electronically. We do have a large number of trustee emails out there. I know not everyone has email, but it's a preferred method, but we also understand that not everyone wants to receive their information that way. So that's something we'll communicate with you about as we progress through. But the next newsletter will be a standard paper-based document that will come in the mail to you. So that's it for today. As I said, it was a bit of an overview. There was a number of changes, significant changes that we need to be aware of, particularly around the pension area. Some regulatory obligations that you need to be mindful of, but we're going to be there to support it from the trustee responsibility point of view, and just that we don't know, or we actually know as much as you know about where super is going to be in 6 months. Thanks very much for coming along. Last thing that I just wanted to highlight too is if you've got issues, don't forget you've got your client managers, your director administrators. A number of them are here and they'll be outside as well to discuss. But if you've got questions relating to your fund, use them as your first point of call. If it needs to be escalated, we have our technical team that can assist with the situation. If it's strategy based, speak to your advisor. Okay, you need to have someone that is licensed to be able to give that strategic advice. So look, thanks very much for coming. I'll be outside if anyone's got any further questions. I look forward to seeing you in June.